In this video we'll dive into what order blocks are, their importance and the different types that exist. We'll also go over the key guidelines for spotting high-quality order blocks and explore high-probability entries using them so you can integrate these setups into your trading plan. If you're just starting out, don't worry, I've kept the explanation beginner-friendly. If you find this content useful, please give it a like and hit subscribe for more in-depth strategies like this. We'll begin right after the intro and disclaimer. Now let's get into the first concept. What exactly is an order block? An order block in trading refers to a defined price area where large market players like major banks and institutions are expected to execute heavy orders. It acts as a tool offering clues about the actions of dominant forces in the market. These zones are often associated with decisions involving major buying or selling activity, typically occurring ahead of a strong price move. Now on to the types of order blocks. We mainly have two bullish order blocks and bearish order blocks. A bullish order block is seen as the final selling candle that appears before a buying rally in a bullish trend. Let me show you how to spot a bullish order block. If a market is trending upward, search for the last selling candle just before the upward push. In this scenario, notice how the market breaks structure by forming higher highs and higher lows, which suggests an uptrend. To locate the bullish order block, identify the last red candle before the buyers stepped in. Then draw the bullish order block from the candle's low to its high. So in an upward trend, a bullish order block is outlined from the bottom to the top of that final red candle. Now let's move on to the bearish order block. A bearish order block is defined as the final buying candle before a selling move takes place in a bearish trend. Now let me explain how. If you notice that the market is trending downward, to detect bearish order blocks, watch for the last green candle that appears before the downward move. In this case, you'll observe a structural break in the market forming new lower highs and lower lows, which confirms a bearish direction to mark. The bearish order block, identify the last green candle before sellers took control. In this scenario, that candle is the buying one. Simply draw the bearish order block from the candle's high to its low within a downtrend. This zone marks the bearish order block. Our main goal is to spot these blocks on a candlestick chart, so we can align our trades with major banks and institutions and potentially profit from market moves. While it's not always simple to locate these blocks, we can identify them by combining confluences and other charting tools. Now that you understand the basics of order blocks, let's take a look at some chart examples of these blocks. If you look at this chart, you'll notice a structural break followed by the formation of a higher low, which confirms an uptrend. Next, we'll draw a bullish order block on this chart. Here we have the final red candle before the price pushes up, making it a bullish order block. The market later returns to that zone, perfectly mitigating the order block, and then rallies upward again, creating a fresh break of structure. This is a bullish order block represented by a plus. Now let's identify a bearish order block. In this chart, based on the market structure, this is clearly a downtrend because we observe a break of structure and the formation of a new lower high. Next, let's mark the bearish order block. This green candle is the final buy candle before the drop, making it a bearish order block. Afterward, the price pulls back, perfectly retesting that order block zone, and then drops further, creating another break of structure. A bearish order block is labeled with a minus ob. By recognizing and examining these bullish and bearish order blocks, we gain valuable insight into potential continuation or reversal points, which can be used for trade entries or exits. Remember, these order block principles are linked with supply and demand as well as support and resistance. Both of these types fall under standard order blocks. Why does price revisit untouched order block areas? Smart money orders can't be filled all at once due to their size. When an order block forms, smart money is unable to enter the entire position instantly, so would drive price in the direction, causing them to buy at higher prices or sell at lower levels. To resolve this, smart money places pending orders within the order block zone so that when price returns to it, those unfilled trades are completed and price resumes the original direction of the move, enabling them to finalize positions. How do we trade using order blocks? As covered earlier, these zones attract interest from institutional players and banks. These traders select these levels for placing major orders, so we should pay close attention to them when price revisits these areas. We can enter trades accordingly before diving into live trades using order blocks. We must apply confluence and focus on identifying high-quality setups, or else losses are likely. In this video, I'll share several advanced guidelines for spotting high-quality order blocks. Before that, if you've gained value, I rely on these rules to pick high-probability order blocks to trade. The rules involve market structure shifts, fresh unmitigated blocks, imbalance or fair value gaps, and premium or discount zones. These criteria filter high-quality order blocks for trading. Let's break down each rule step by step. Using examples from a real chart, if you examine this chart using market structure, it shows a shift from bearish to bullish. This happens because we can identify a change of character on the chart, so the rule of market structure shift is valid here, and you may also spot a break of structure following these conditions. Now let's locate the bullish order block. Look for the final red candle just before the strong upward movement. This candle marks the bullish order block. This specific block qualifies as an unmitigated order block based on another rule. Simply put, mitigation means price has interacted with our chosen zone, while unmitigated indicates price has not yet touched that zone. Now moving to the next rule, we need to identify fair value gaps after an order block is formed. You can spot candle inefficiencies here, which means we can mark the fair value gap zone like this. Next, let's go over the rule involving premium and discount levels. Draw the tool from the recent swing low to the swing high. Once it's drawn, check where the order block lies within that range. If the tool shows our order block is within the discount zone, then it signals a buy trade opportunity. These are the rules we follow to identify high quality order blocks. Now let's go over high probability trade entries and exits. Once you've identified a high probability order block, you can look to enter a buy trade anywhere within this zone by watching for price action signals on a lower time frame. Next, place your stop loss just below the order block zone to control risk if price doesn't react to the block as expected. Adjust your position size so that a stop loss hit only risks a small portion of your trading capital. For taking profit after entering the trade, aim to close the position near significant swing highs. Always consider your take profit level based on your risk to reward ratio and the likely price move originating from the order block. You can also improve results by combining other price action techniques in your trading plan. In this video, I demonstrated only a bullish order block setup, so make sure to backtest the same strategy for bearish order blocks by applying the rules in reverse. That's it, traders. Appreciate you watching this video. I hope you found this content helpful. If you did, feel free to tap the like button to show your support, and make sure to subscribe if you're new to the channel. Catch you in the next episode.